Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, my name is Ryan and I am a mortgage nerd. I'm with Patriot Home Mortgage here in St. George, Utah. I do lending in Utah and Nevada, and I am a mortgage nerd. Check out my shirt. It's a pretty cool little shirt, huh? So I kind of came up with this little side idea that I like to nerd out on all kinds of different things. And so I kind of came up with these different logos and different ways to kind of spell the word nerd and kind of intertwine it within a bunch of different things. And so if you go to Nerd Merch, and nerd is with a 3, as you can see on my shirt, it's N3 instead of an E, just kind of a fun way to say nerd. If you go to nerdmerch.com, there's all kinds of different categories. I'm coming up with new stuff every single day and just kind of having fun with just coming up ways to nerd out. People nerd out about cars. They nerd out about math and computers and science and all kinds of fun stuff. So you can see on my website, there's a whole bunch of different things. So if you have a nerd in your family that's proud of nerding out on all kinds of fun stuff, maybe get them a hat or a mug or something like that. I think it's kind of a fun little side project of mine. I try to keep the products at pretty good quality, but not really high margins. So it's not really a big money thing. It's just more of a fun little hobby, kind of a side thing that I'm doing. So it is a lot of fun. So check out nerdmerch.com and get a hat for your favorite nerd. All right, so today I want to do another Q&A video. We're going to jump on and answer some of your questions about credit, real estate, mortgage, whatever there might be. So Freddie Mac, my producer here, we're going to find a couple of fun questions for you and just see if we can answer your questions. And if you have questions, please comment, subscribe, like, share the video, and check out my Facebook page. Everything's under Mortgage Nerd. Check that out, and I can answer questions on a future video. But Freddie, what kind of first question did you have for us today?
All right, I've asked this question before. What's the best way to build up my credit score?
Well, to build up credit, you have to have credit. Yeah.
Okay.
To get credit, you have to have credit. Sorry.
Isn't that you have to have debt? You have to manage debt. Isn't that the proper way? To get credit, you have to manage your debt.
Yes, that's part of the credit. So one of the best ways is revolving accounts. That's how the credit bureaus were first created. They were designed for these revolving accounts. Now, a revolving account is like a Visa, MasterCard, a gas card, a store card, Old Navy, anything where it gives you a line of credit, where you have a $2,000 limit and you buy $1,000 worth of stuff and you slowly pay it down, and then you can borrow that same money back again. That's what they call a revolving account. Where an installment account's like a car loan, where you get the $20,000 for the car and you make the $500 payment until it's paid off, but you can't borrow that money back. So revolving accounts are one of the best ways to build your credit. You can do a secured Visa, where you actually take $500 into the bank. They'll give you a $500 Visa. This is one of the great ways to build up the credit file. Now, the downside with that is you're giving them the money they're loaning you at an interest rate. So you don't want to do that forever. You're basically borrowing your own money. But it's a way to be able to start that credit cycle, start building your credit. You can also go on to Experian.com. You can report utility bills, cell phones, other types of history you can actually report, and it can actually be added to your credit file as well. So you're not really adding new debt, you're just showing a payment history. So these are some of the early ways to be able to build your credit. But one of the most important things after you've established or started having some credit issues is those revolving accounts. Now, you don't want to use them and pay it off, use them and pay them off, because whatever reports on your statement is what they report to the credit bureaus. You're better off to keep the balance under 30% of the limit. When you're under that tier but not zero, so somewhere between $1 and 30%, that's where you'll see the biggest boost to your score. And I have people tell me all the time, well, I use it, pay it off for business or whatever it is. But every single month your statement comes out and you have a $3,000 limit and you owe $2,900 every single month. Even if you pay it off that very second, it doesn't report until the next month. And if you slowly used it back up and paid it off again, you don't get the boost to your score. So the best tip is to not think it's a $3,000 limit, think it's a $1,000 limit, and always keep it under that number. You can see as much as a 35% jump to your score with just how you handle revolving accounts. And if you don't have a revolving account, you're missing out on part of the algorithm. So that's one of the best tips is to manage or get a revolving account.
While we were talking, I just paid off my credit card.
Did you? Okay.
I did.
Well, your scores are going down. Sorry.
Yeah, it was a good dinner at Outback though. Pricey one. The wife had a couple drinks. So many. All right, next question here.
And it is something where, it depends on when they report. So by the time that reports, maybe you've used it back up again. So it's always on these 30-day cycles. So it's never exactly every single day what your balance is. It's whatever's on your statement. So try to make it so it's never zero, but never over 30%. That's the best way to boost the score.
So I have a couple credit cards and a regular debit card. The debit card I probably use like 90% of the time. And the credit card I use, I guess when I have to go out to eat for restaurants, because sometimes I'll notice that if I use my debit card, the tip I put on the card won't be applied if it's a paper receipt situation. And so I end up using the credit card to make sure that there's a tip involved. So this goes to the next question. What's the best way to use a credit card?
Yeah, I mean, the best way to use it is to use it and then pay it off. There's all these points, bonuses, rewards. There's a lot of stuff they build into these things knowing that you're not going to pay the thing off every single month. So you want to try to get paid off within the 30 days or within the billing cycle, because a lot of times you don't accrue interest till the billing cycle ends. So if it's back down to zero during that time, you get all the bonuses, rewards, points, and all that type of stuff. The problem most people have is they'll get a $5,000 credit limit, spend more than they can pay off in a certain month, and all of a sudden they start carrying a balance. And that balance is a much, much higher interest rate than a mortgage or a car loan or anything like that. But if you manage them, they're incredible financial tools. They're giving away free money if you manage it correctly, or points or airline miles or all that type of stuff. I think the biggest thing is when you use it, go right onto the app and pay a payment, or just make sure you pay that payment as soon as you can after the transaction so you don't start carrying these really big balances. That's why the credit card industry makes so much money, is not only the rate's a lot higher and the annual fees and all that stuff, but they know you're going to carry a balance for month after month after month. And most people get it to the point where they max it off, make a payment, and then borrow that same little amount back every single month. It's a very vicious cycle. And also, they'll try to raise your limits. If you get to the point where you're always using about $1,000 a month or so on the card, and you got a $3,000 limit, all of a sudden they bump you up to $10,000, I really recommend lowering that back down. Call them and say, nope, I don't want it at $10,000, lower it back down to $5,000. And just be aware what your limit is really isn't your limit. Try to have in your mind, okay, it really isn't a $3,000 card, a $10,000 card, it's $1,000. And don't borrow it more than you have to unless there's some sort of emergency or something like that. So managing it is really what makes it a financial tool instead of a financial liability.
All right, next question here.
Right.
Can hackers change my credit score?
Ooh, can hackers change my credit score? I mean, hackers can do a lot of stuff, but that would be really hard because they'd have to hack a specific trade line to report that differently, or go into the algorithm and change it. And as soon as anything updates the next month, and all of a sudden the hack is gone. So I can't say they couldn't, like, temporarily maybe somehow go in there and mess up the algorithm or mess up a trade line or something like that, because it's all computer generated with Experian, Equifax. It's an algorithm. It takes in the factors that they factor, which is credit history, time on the job, or not time on the job, excuse me. The job history really isn't on the credit report. It's going to be revolving accounts, time, late payments, how old an account is, how many inquiries you've had. So you could affect those in some way to affect the score, but it'd be a very temporary thing. It wouldn't be a permanent hack. So I can't say they couldn't, but I don't know if anybody's really tried to, and it wouldn't be a permanent thing. So
they can't hack your credit card score, but they can hack your credit card,
right.
Run it up, and
which could affect the score.
The byproduct would be the credit score.
Right.
But on the opposite end, they couldn't hack it to increase your credit score.
Right. If they did, it'd be a very temporary thing. As soon as something updated, like a trade line updated, then all the data updated that month, and all of a sudden the score would just go back to what it was. So could they? Yes, theoretically, but would they, and why they would? I don't know, and it wouldn't stick. So I don't. That's be interesting to find out who came up with that question. But so I'd say yeah.
All right, next question. What's the best way to increase someone's credit score fast?
One of the best ways is those revolving accounts. They update every 30 days. So anything within a 30-day cycle is what you want to update. One of the tips I can give you when it comes to making sure you don't go backwards is, let's say you have an old collection account that you just forgot about, or a cell phone you didn't turn in, or you see equipment like somebody rented some internet box or a dish or something like that and didn't return the equipment or something, and they charge them $300 or something like that. Or you'll see somebody that has an old account they didn't touch and they have an annual fee, and all of a sudden they see it pops up as a late. What you want to do is you want to see anything that's the oldest stuff you don't want to update necessarily. So if you have a collection that's 3 years old and you pay it, suddenly it's now paid, but now it looks like a new paid collection instead of an old one that hasn't been addressed. So the first things you want to look at are the most recent things reporting. Those are the things you want to dispute, pay off, settle, whatever it takes to update that trade line, because they're already reporting every single month. If you update an old trade line, you actually go backwards a little bit. Now, you're going to hit an artificial ceiling until you deal with those collections or charge-offs and start kind of settling with them or whatever you need to do. You're always going to kind of have your score never really go over a certain amount. But I see a lot of times people will try to fix their credit and they go backwards for the first couple months before they start really seeing their score go up. So the first thing we talked about already, revolving accounts. They're the fastest thing. They're every single month. Updating that correctly, paying them down, that will help your score the quickest. The next thing is the newest or the most actively reporting derogatory credit. Attack those first. You still want to deal with the old ones, but deal with the new ones first. So you're kind of building positive while you're getting rid of some of the old stuff. But I'd love to help you with that. If you need help with credit repair, there's so many times I work with a client that we need 6 months of just kind of cleaning things up, going through the cycles, finding out why the score is the way it is, and then we can get you into a home loan. Credit works for home loans and auto loans, employment, insurance. It's tied to so many things. So working on your credit, because they go on these 30-day cycles, is one of the best things you can do for your financial future.
So if I want to go from 550 to 750, how long is that going to take?
That's going to take a long time. If you try to get into the 700s, it's a lot of history that you're building up, a lot of positive history. The old stuff really has to fall off. But it also depends on why you're a 580 score. So it's very difficult to get into the 700 without just a lot more time. But if you get in 660, 680, you're getting into better tiers. On credit, all that kind of stuff, that 680 is really a magic number that most of the better loans start to kick in at 680. You don't have to be 750 to get 100% financing or the best interest rates out there. But if you get under 680, that gets a lot harder to get better interest rates. So the goal, I think, is 680. Once you get to there, then it's just going to be building on what you've learned and what you've done. You'll get to the 700s eventually, but it's going to take a lot of time to get in the 7s. But 6s, very doable. I've gotten people from 580 to 620 within 2 cycles, within 60 days, just with knowing why the score is the way it is, getting some positive added to it, and just get rid of some of the negative things. So it's not crazy hard to start getting back into the 6s, but 500 credit scores, that's awful. It really is, because it's not hard to get back into the 600s. So when you have a 500 score, you're well below. You're hundreds of points below the average for your state. So working on your credit is really a key step. And I see way too many people wait till their lease is expiring and they got to move out in 30 days or 90 days. It's like, man, if we would have had a little more time, we can get you a way better loan. So start on it early. It never hurts to start working on credit early. All right,
next question here. Can you pay Peter by robbing Paul? Can you pay one credit card bill with another credit card?
It depends on if that merchant will accept a credit card payment. Like some of them won't actually accept. You have to do like a checking account. So it does depend on the credit card. But the answer is yeah. Most of them will accept a credit card payment. But of course, now you're just moving debt from one to the other. It's really about where is your money going? Where's your budgets going? Is there ways you can start finding other expenses you can cut so you can actually start paying the payments instead of doing the Rob and Peter to pay Paul kind of thing? Now, people run into all kinds of financial reasons why they have to do that. But there are credit card companies that will accept a credit card as payment, but many, many, many won't. They'll want it tied to a checking account. It's like a HC or a ACH transaction to make the payment. So it does depend on the credit card, but many of them will accept the card payment. But you sometimes will also see that that's considered a cash withdrawal. So you might see a higher rate on the card you're using or a fee to get access to money in that way. So you really want to check the terms of what it takes. And if you're in that situation where you can't pay the credit card without using another credit card, really start tracking where your money's going. There's amazing how many times I sit down with people that have financial difficulties and we start looking at their income, we look at their bank statements and go, wow, you're spending a lot of money eating out, or you're spending a lot of money on these things, or what are all these expenditures? If we start just minimizing, kind of cutting those back, you'll amazing how it kind of is a snowball effect. You'll start getting ahead. You'll start getting some of the cards paid off, and it just takes a little bit of management. It's kind of like when you're trying to lose weight, you got to start tracking what you're eating. When you're trying to get out of debt, you got to start tracking your money. You got to see where you're actually putting your money and start realizing, wow, I'm spending X amount of dollars on this. I could definitely cut that. And sometimes you just don't realize what you're spending money on. So tracking it, I think, is the best way to get out of that rat race, so to speak. All right, what else we got?
All righty. What is considered to be a good credit score?
Okay. Good would be 680. Most criteria, especially for mortgages, 680 is kind of that good credit score. If you're under 680, you're kind of under national averages in most cases. So that's really kind of where they come up with that number. When you get into 700, you're starting to get into the better. When you get into 740 or better, you're in the A+. You're in kind of the top tier when you get into 740 range. But when it comes to good, I would say 680. Most lenders are going to consider that a good credit score. Not great, but not bad. If you start getting into the lower sixes, the fives, that's when you're starting to get into kind of D and C and F kind of credit is when you get into the fives. So short answer, 680. Anything 680 is a good credit score.
All right. I was actually, while you're talking, I got on my phone and started looking at some stuff. Ooh. So I have a couple credit cards.
Okay.
And I have the Credit Karma app.
Okay.
All three of them tell me different credit scores.
Right.
Two of which say that they're FICO. One's TransUnion and one's, what's the other one? Equifax.
Yep.
And they're all different numbers. They're all in the general area, but why?
Yeah, so each algorithm is slightly different how they weight certain things. They also have a different starting score. So that's where you'll see like Experian has usually the lower score in Utah because it has a lower starting point than the other bureaus. They also will weight things differently. With mortgage, we rely a little bit more on previous mortgage history. So you'll actually see when we pull a mortgage credit report, it's weighting things differently because we're lending for a mortgage. So in Credit Karma, they're using more of a general FICO scoring model that isn't as specific if somebody's applying for a car loan, insurance, mortgage. So they have little different models on how they weight that person's score, but they all have a little different start value. Their algorithm as far as what they weigh will be slightly different, and that's why you'll see different scores. Very rarely, in fact, do I see the same exact score, especially all three scores, and they usually have differences. Here in Utah, Experian's usually the lowest, Equifax is usually the highest, TransUnion's usually in the middle from my experience. And some of that also has to do with the repository for the state. What that means is if you're a lender and you want to report to credit bureaus, in Utah, you have to start with Experian before you do the others. So they usually get more data, more reporting, more lenders. If they only want to report to one and not the other two, Experian usually gets a little bit more data. It usually gets more inquiry hits. So it usually is the lower score here in Utah, and I think that's also in Nevada. But they just have a little different models, and so the scoring can be just a little bit different. As a loan, for a mortgage loan, we pull all three and take the middle credit score. So we don't add them up and take an average. We don't take the lowest one. We take whatever's in the middle. So you could be, say, a 680, 685, and a 900. We'll still use the 685. We'll use whatever score is in the middle. Now, there is an exception to that if there's a derogatory only reporting to one bureau and you've got, say, a 700, 700, and a 580, they're going to say, okay, well, the other two are not reporting. So there is some guidelines if there's major differences, but generally it's always going to be the middle credit score of all three. That's a long answer to that easy question.
Wow, that is, it's like asking four different girls if you want to dance. And like, maybe, possibly, yes, no. Well, which one is it? Do I get a dance or not? So...
Word salad.
The other thing I noticed is that my FICO scores went down, but my TransUnion and Equifax went up.
Yeah, it just depends on what was reported. You can also, based on the time of the month. So right now we're what day is it?
13th.
The 13th. Maybe some have started to report for November and others haven't quite reported yet. So it depends on the billing cycles. Most of the time, this is where you start seeing November start to report. You usually don't see it on the 1st. Usually, some will wait till the very last business day of the month. So all of it comes down to when the credit cards report. They don't all report on the 1st or the 15th or the 20th. They all report at different times and different segments. They may be 30 days behind. They may be right up to the November 13th date. Because a lot of times they'll compile the data ending the billing cycle. Then that's when they mail out the statements or report the statements. So that's usually when they also report is the date those statements are produced or the end of that billing cycle. So it can be different. I see it different all the time within even days. Days different because of the way it reports. Good question.
Does canceling credit cards affect your credit score?
Yes, it does. Here's why. If you have 3 credit cards and the 2 are maxed out as you're paying off the one, your balance to limit ratio spreads on the other 2 cards that are active. So the best way to do it is get all the balances under 30%, then start to close the cards. Also, you'll lose that history. If you have a card that's only 12 months old and one that's 36 months old and you close that one, now you've also lost that history. So there is a balance between which cards to close and which ones to pay off and which ones just to leave open. But that's why I see a lot of times if people start getting aggressive, they focus all their attention, their extra money on that one credit card while the other 2 are maxed out or over the 30% limit. They get it down to 0, they close it, and all of a sudden their score takes a hit because that's exactly what happened. The balance to limit ratio is spread out over 2 cards instead of that 3rd card. So you're better off to get them all under 30%, then close the accounts that have the lowest history or the worst terms. I mean, there's always a balance between what helps your credit versus what helps your finances with interest rates and things like that. So you want to balance that. But generally, that's why the score takes a hit in most cases, is not only are you losing history, but now you have less limit, and you've just increased your balance on your limit by removing that positive account. So that's why you'll see your score actually take a hit unless you spread out paying them all under 30%, then start paying them down. That's the best way to do it.
All right, next question here. How do
Give me a real short one.
Oh, okay.
Just kidding.
How do I buy a house? No. How do credit repair companies repair people's credit?
Okay. The Fair Credit Reporting Act is a law that allows you to dispute things that are on your credit. So I always use the analogy, it's kind of like your ticket. It's not your conviction. The credit report is just the data that is out there. They have to prove that it's accurate. So credit report repair companies, they will basically request the credit bureaus and the creditors prove that that was a collection, that it was ever late, that it's all that. So a lot of times the credit repair companies are relying on the fact that the accounts are old or they're paid and they just need to be removed. That's why the credit repair companies make the money that they do, is they simply go through and dispute the items that are on your credit and force the credit bureaus to prove what's on there is accurate. Now, what you'll see is they'll dispute it. The credit bureaus just respond, yep, that's accurate. And what they'll do is dispute it again. They'll just kind of keep disputing it until they finally either delete it or it gets paid or zeroed out. Now, that doesn't mean that the debt isn't gone. It just means it's not on the credit bureaus. But where it's most effective is on accounts that are actually erroneous, that are wrong, or have been paid and just have not been deleted. Oftentimes, that's what I'll see is they'll report a late or report a collection, they get paid, and then they just stop reporting. So whenever they last report, it just kind of sits there until you dispute it. So it's kind of like changing the oil on your car. You can do it on your own or hire some of these companies. There's a couple that I recommend that actually are worth the money that pays for it. What you don't want to see is these huge $2,000 and $5,000 bills to have these people do the credit repair. They're not doing anything special. They're just going through the laws and the dispute process. They're just doing it for you instead of you doing it for yourself. So if you want a recommendation, if you want some help, check out my website at ryanbolton.com. We can pull a credit report. I can give you some tips on what's on there. And if you really do need somebody that can do the credit repair, I can refer you to a reputable company. But unfortunately, there's a lot of weird stuff that happens with credit report repair, and some of these attorney firms is what they'll call it. They charge ridiculous amount for some of that service when really they're not doing anything special. They're just doing it more persistently. They have some systems in place, but really there's better ways to do credit repair.
All right, so this one's off the top of my head.
All right.
Speaking of pulling credit, now I have the Credit Karma thing, and then I have a couple other places where I see my credit scores. But when it comes to pulling your credit, I've heard that some places, if they pull your credit, if it's like a hard credit report, is that what it's called?
Yeah.
Where that will ding your credit, or if your credit gets pulled too many times, that dings your credit.
Yes.
And then on top of that, I've had a situation where I was unable to do something because of something in my credit, and it was like pulling teeth to find out what that thing was that I need to fix. So why is it that I get dinged for finding out what my credit is, and how can I find out if there are derogatory, if there's late or all that?
There's a couple things there. Every year now, I think they're going to 6 months. So every 6 months, you can pull a free credit report that's the actual information on the report. It doesn't give you the score. You're paying for the actual score to figure the algorithm and actually kick out a credit score. So the score you usually have to pay for, but the history you can get on that annualcreditreport.com. They have to provide that every year. They're going to every 6 months here pretty quick. So that's first. Second, credit inquiries. They now allow for a shopping period. So if you're shopping for a car and you get an inquiry with the dealership and the credit union, the bank, all these inquiries, all of a sudden your score just starts taking a big hit. Recently, they changed it to allow a shopping period where you can have the same style of inquiry within a similar week that doesn't hit you all as separate inquiries. But then once you pass that shopping period, the inquiry hit is worse. Now, the reason for this is, let's say that I'm a lender and I see 5 credit inquiries with Capital One and Chase Bank and Wells Fargo and all these different lenders. I don't know if those resulted in debts. They usually take 30 to 60 days for that inquiry to actually show up as a new trade line. So that could have been 5 new car loans, 5 new mortgages, 10 new credit cards. So that's designed to kind of curb the spending and curb the ability to let the credit bureaus catch up. So they use that as a way to slow down acquiring new credit till you have time to have it actually show up. And usually when you see a whole bunch of inquiries start showing up, there might be some sort of financial problem or issue or something popping up. But they also recognize people would go to a car dealership and get 10 inquiries. So they do allow the shopping period now, but once you get past that shopping period or do multiple types, you'll start seeing your score go down. It recovers usually within 90 days or until that trade line actually shows up. But that's really the reason behind credit inquiry hits is just slow down the spending until it has time to report. That's really the mathematics behind it.
Okay, we're short on time. One last question, yes or no. Should I use my credit card to buy Bitcoin?
Ugh. No.
Can I?
Yes. I think
Should
you
I?
can. That's a tough one. No, I think the rates and terms, there's just better ways to pay for it than using a credit card. But the rate of return on Bitcoin has been crazy. So anyway, thanks for watching. Check out ryanbolton.com. Check out my YouTube channel. Answer questions, all that stuff. We'll see you next time on the next video.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.